Welcome to a Wiser Retirement Podcast. We put together a guide with some recommendations to help you focus on being financially fit at different milestones in your life. Some of you may be ahead of schedule, while others may have to play catch up. You can download this guide for free on our website. The link to download Your Path to a Lifetime of Financial Success is listed in the episode description. Or you can go to wiserinvestor.com, scroll to the bottom, and find it there. Now on to today's episode.
Welcome to a Wiser Retirement Podcast, where we believe the best financial advice should always be conflict-free. I'm your host, Casey Smith. Guiding you to financial freedom today are my co-hosts, Brad Lyons and Missie Beach. Hello.
Hi, Casey.
Hello, Casey.
So this is like a big deal. Missy's in our third week here?
Yeah, fourth week. Time flies.
Fourth week. Oh, yeah, there's a lot of things that start happening in your fourth week. I forgot about that. Yeah, our fourth week, and she is joining us on our podcast today. Missy is a senior financial planner with us. Senior not because of age, but because of experience.
Thanks for editing that.
Missy, glad to have you with us and then joining our conversation today.
Thanks. Looking forward to it.
Brad, we're getting closer to a decade you might remember, your 40s.
We're getting there.
We're getting there.
Fortunately, that we'll move faster than those decades actually did. So
right, yeah, that's true.
Yeah,
is that good? I guess that's good. Do you remember your 40s?
I do.
Good deal.
Yeah, all of them.
40 through 49.
Yeah, you bet.
Okay.
Yeah, I made it.
All right, you made it. Well, I know you wouldn't remember your 20s and 30s. I mean, but
yeah. Well, it gets a little crazy when you're in your 40s.
Yeah.
Yeah. Things start to unravel.
Oh, yeah, they do. Yeah, I know. I'm in my 40s. I get it.
Yeah.
By the way, thanks for asking Brad and not me, if I remember.
I knew not to do that, Missy.
Good call.
You're too new to for me to rub you that hard. Yeah, you know.
No harassment in the fourth week.
That's.
We have to save something for the fifth and sixth week.
Yeah, right. You have to wait until the 12th month for that one. Well, all right. So today we're going to focus on planning in your 40s and things that you should be doing in your 40s. You know, I don't know. I mean, we meet with a lot of people in their 40s. I'm in my 40s. I think that things definitely start speeding up if you have children. If you had children, it kind of like the statistically normal time, I guess. But yeah, there's a lot of things that can get away if you're not paying attention, because you tend to not focus on maybe finances as much as you probably should.
Yeah, the rate at which life comes at you in your 40s is extremely fast. And finances can be one of those things that you just kind of set aside put on pause maybe.
Yeah.
And we need to spend a little time today telling people to wake up and bring that back out of hibernation and think about their finances a little bit.
I mean, statistically, you're making more money in your 40s.
Which is a good thing most of the time,
right.
But a lot of times you're also trying to keep up with the Joneses. You make more money,
True.
You're not always saving all that money.
Right. And to be clear, I mean, we are financial planners, right? And we want to talk about saving and doing the right thing for your money. And I just want to be really clear that every dollar has a purpose. It's okay that you splurged or you did something, as long as you had a spot for that. You know, maybe you've worked hard. You deserve maybe a break or a girl's trip or a guy's trip or whatever it is. You just don't want it to be excessive.
Yeah.
To the point where you're doing your future self a lot of harm. Or the big thing is, you should not be accumulating debt in your 40s.
Oh, that's huge, Casey. That's
right.
huge. Mm-hmm.
You should not be accumulating more debt in your 40s. It's time to put it's almost Halloween, right? It's time to put a RIP headstone over your debt and bury that sucker. You know.
That's a good analogy.
But it's a mindset, though.
It is, because in your 40s, it's the Joneses, yes, but it's also internally within your family. You're simply doing the things that the family wants to do, and as they're aging, they're growing. The things that they want become more expensive. The things you want to do becomes more expensive.
Yeah,
and it's just difficult to,
I remember a time in my life
do that because you begin to see that the time you have with your family is shortening.
Right.
The kids are getting a little older, and they're about ready to go to college, and we're going to talk a little bit about that, I'm sure. And you realize that, well, if we don't take this summer vacation this year, I don't know that we're going to get a chance to do that again. So there's a lot of competition for that dollar, that purposeful dollar, if you will. This is a good way.
My feeling is I remember a time when I felt like $100 could fix something. And now I feel like it's $1,000 at least to fix something. There's $1,000 problems, not $100 problems, right?
Right.
I mean, sometimes it's just time. I need to hire a professional to do something where maybe in my 20s I would have taken a stab at that leaky faucet. You know,
that's a great point. Is our time does have value, even if it's a recreational time. You know, we're spending our time doing something, so we can put a dollar amount on it. And you're right. Maybe it does you just pay to have it done so that you can move on with other things that have a higher priority. But then that costs money. Okay. You talk about hiring a professional. I mean, it costs $100, $200 just to have them come to the house now.
Right.
They have a show up fee.
Right.
Yeah.
You do have to look at the highest and best use of your time. You're absolutely right. Because time with your family is important, just like you were saying, Brad. You know, it's very limited. But then you have to know where to draw the line, and that's the hard part.
That is difficult. And as financial planners, part of that is, you know, clients come to us because they want to elevate the highest and best use of their time by working with a financial planner rather than on their own, or worse yet, even putting it on pause and thinking they'll do it later.
You know, and I think that's what we do a good job of, is giving our clients a set path to live within where they can spend their dollars intentionally, and they're able to spend on certain goals and wants and needs to have that fun with their families and go on these vacations and do it without guilt, because they're spending within their means and they're able to go have a fantastic time because we've built this plan, and they know that they're living their best lives and they can do it within their means and have a wonderful time, and it's going to work out in the long run.
I think ultimately it goes back to pay yourself first, right? Mindset. You've done financial planning, and you're going to make sure that you have you're putting away every month the money for your future self. So if you start there and you have enough in emergency reserves, theoretically you could take your account to zero if you wanted, your checking account to zero, because you've placed everything else that's important in the right buckets, right?
So one of the most important things that we can do for ourselves in our 40s is to take our finances off pause and to create a plan, right? You know, to know that what we're doing with every dollar that is coming through our checking accounts that we're earning and so on, that it has that purpose. It's being saved, it's being spent. We know that we're doing everything we can to advance our plan, you know, towards our goals, college, debt reduction, retirement, etc. And then within that, we're living our best life all at the same time.
You know, Brad, and I think the first step to doing that is getting organized. And when new clients come on board at Wiser, that's one of the biggest hurdles for some of them to get over, is to consolidate old accounts. I feel like in your 40s, a lot of times people will have abandoned 401ks from previous employers that are kind of strewn all over the place, and maybe these little accounts that they've opened along the way. And, you know, they have statements and they kind of know that they're out there, but it's really hard to manage all these accounts when they're just little accounts all over. So I think in your 40s, this is a great time to pause and to get everything organized and all in one place. Get everything at one custodian so you can have one login and see everything on one computer screen, and just make it easier to manage.
Simplicity is important, especially those that are older in their 70s and 80s. You know, I'm always like, let's make this easy on the kids. Let's bundle all this stuff up. Another thing is I think in your 40s, you're starting to realize that time is moving faster than maybe what you thought it would. And there's only 20 years. We started working in our early 20s, and now we only have, if you retire between 65 and 67, you've only got about 20 years remaining. That's why you got to have a plan in place.
Of your working life.
Of your working life. That's
Not
right.
of your spending life.
That's very true. That's very true. Which means you need to be working harder those last 20 years to make sure you're achieving those goals. The IRS is going to help us, though. Do you notice that?
Next year.
Yeah.
Mm-hmm.
It's the biggest increase in years that they're going to allow for pre-retire or pre-qualified money, pre-tax money to go into our 401k account. It's going to go up to what, $22,500.
Yeah, I just did an educational video for our YouTube channel, A Wiser Retirement on YouTube. I'm sure Hadley will plug it into our show notes here, but the summary of it is basically you can put away $22,500 a year into your 401k starting in 2023. Right now it's $20,500, so that's a big increase.
It is.
And
It's huge.
for those
And to
of
catch
us over 50.
We haven't gotten there yet. That's the next podcast.
Can I be a spoiler?
Go ahead.
30 grand a year. I mean, that's huge.
It
mean,
is.
compared to this year.
I was trying to figure out how many people actually max out their 401ks, and I only found data from Vanguard, but Vanguard, there's a lot of Vanguard 401k plans, so the data set's pretty deep. But 14% of people in America can max out their 401k. That's pretty high considering there's probably 80 that don't even save. So, right. So,
Oh, you think that's high? 14%?
I think it is.
Yeah, I guess so.
I mean, if you account of all the 401k participants, which that's a lot of participants across the Vanguard platform, I think it should be higher. It should be 80%.
Agreed.
But if you look at credit card debt levels, and we're over $1 trillion in credit card debt, that for the most part, especially in this last year, Americans are spending more than they make, and they're using credit cards to support that. During the pandemic, we couldn't spend our money, and so credit cards went way down during that time period, which I think is really fascinating. It just shows you how it's like a side tangent here, but it just shows you how much people are followers and how good marketing is.
Oh, yeah.
We've said on past broadcasts that the marketing done by consumer debt companies, credit card companies, and some of these others is some of the best in the world. It really is.
Yeah.
They have us all convinced that it's normal, to
saw
go
one
out
recently.
and borrow money at 20%,
Yeah.
and then pay back, and it's good for us. It's good for our credit, according to them. It's good for us.
I saw my credit union advertising a vacation loan, and it said, and the tagline is caption line was "You deserve it," and I was like, "Wow, that's."
You deserve to bury yourself in debt and interest payments for years.
On something that you can't even liquidate to repay back. Really, isn't that crazy?
Yeah,
that's sad.
I thought that was kind of a new low, but I get it. They're trying to lend money, and
that's how they make money.
Credit union people have probably less default rates than others. Maybe, I don't know.
So if you're in your 40s and hopefully by then you don't have any credit card debt, maybe your mortgage is your only debt that you have by the time you're in your 40s. But in your 40s, you're in your highest earning years. So a lot of people will go out and upgrade their housing in your 40s. So what are some of the perils of upgrading your housing in your 40s and taking out a new mortgage?
Not getting it paid off by the time you retire.
Bingo.
Yeah.
And also, heaven forbid, taking on a 30-year loan, when you're 45.
In your 70s before you get your house paid off.
Exactly. So if at all possible, if you're going to get a new loan in your 40s, gosh sakes, get a 15-year mortgage.
Surprisingly, I've been doing this for 22 years. I think the two things that people fight us on the most is that people want to take Social Security right away. Sometimes at 62, even when they're working. It's like, doesn't make any sense, right? You're even limited.
Take it now.
You lose. Yeah. Anyway, or definitely at full retirement age or just prior. They don't want to wait till 70. And then the second thing is paying off mortgages. They have a hard time going, you want me to pay my mortgage off? You want me to send extra money to my mortgage? I'm like, retirement is not about rate of return first. It's about cash flow. And so if you don't have that big payment going out, you can retire on a lot less money.
Right.
You know, and my dad retired from Delta Airlines, and one of my son's golf tournaments recently, he was telling me, he said, yeah, guys used to walk around the office saying they had to have all this money to retire because, you know, they could work because they had all these debt payments, their truck payments, their house payment and everything else, right? He's like, well, if you're debt free, you don't have those payments, you can live on a lot less. I'm like, yeah, that's a very simple way of looking at it, and it's also the most accurate way of looking at it.
Simple.
And yet, 9 times out of 10, when we bring this up with people, you know, it's like the light bulb just.
I know,
like
right? They've never heard that before.
I know it.
I bet you.
It goes back to how good marketing is done by the lending companies. We're just so accustomed to making those payments. It's just structured in us. But the reality is, the first month that you don't have to make that payment, it's like having a tax-free raise going through your checking account.
Absolutely.
Yeah.
You're right, Brad.
Yeah.
It's habit. People are like, oh, I have a mortgage payment.
Everybody has a mortgage. Sure. Why not? You know?
But it's the same way. I mean, your friends have mortgage payments. They have car payments. They have probably some credit card debt. They have some personal loans. They have some home improvement loans. And it's like, oh, yeah, this is just normal because that's how normal people live, right? I mean, Dave Ramsey's made probably billions at this point off of trying to get people to save and handle their money like your grandmother did, right? I mean, it's really simple advice. And it's hard to do it. It's hard to do it because especially if you're in a metro Atlanta or metro area like we are, and you see these beautiful homes and these really nice cars, and we talk about this all the time on our podcast, but you know, there's a lot of rich people out there. There aren't that many wealthy people.
Rich, not wealthy. You got it, Casey.
Yeah.
Mm-hmm.
Yeah. I tell my kids, like, they're rich. They're probably not wealthy. Now, there's a few people that I know that are rich and wealthy. You know, and good for them. Good for them. That's the American dream, right?
Sure.
Okay, so a couple of things. We have a mortgage calculator. We can link that in our show notes too. If you go to wiserinvestor.com/mortgage-calculator, you can type in your current mortgage information, and you can say, hey, what if I pay an extra $500 a month or $100 a month or $200? How much is that going to save me? And you can get that mortgage paid off prior to your retirement. So I would challenge you to do that. If you're already a Wiser client, we've already done that for you.
Yes. But
or you don't have a mortgage.
Yeah, you'll be amazed at the interest that it'll show you that you will save over the years and how many years early you can pay off that mortgage.
There's a client last week. It was $233,000 in interest savings.
Yes. Mm-hmm.
They saved $200 by sending $2,000 extra a month to the mortgage. They saved $233,000 in interest.
And I think that's where the focus needs to be, on the interest savings instead of focusing on the interest rate.
Oh yeah, absolutely.
You know?
Right.
And I think now in today's interest rate environment versus maybe last year's, it's going to be less of a focus.
Right. Yeah. Yeah. I mean, you're paying 6 1/4 now for a 30-year, maybe 6 1/10 on a 15-year. Mm-hmm. There's not much difference between the two right now.
No.
That's a lot of savings.
Yeah.
And then, you know, someone out there is going, yeah, but I got a 2% mortgage and I can invest that in the market and I can make more money. And you know what? If you want to gamble your house, gamble your house. But that's not what I always flip it and say it this way. Would you borrow money? Your house is paid off. Would you borrow money at 2% and then invest it in the market? Would you do that? Most people say, no, I would never, ever do that. Well, if you have the ability to pay off your house, it's the same thing. It's just reversed, right?
Yeah. No one borrows gambles on their house.
No.
That's just not a thing.
No. Well, I think it is. I mean, I know people have done it, but it's different. Mm-hmm. They've got lots of millions of dollars over here, and they're
yeah.
Yeah. That's the problem, is
leveraging like that.
Yes, we're listening to very wealthy people and how they use their money to make more money, and we're trying to replicate that in a very small, very different environment where you've done well, but you're not sitting here on top 100 in Georgia wealth list, right?
Correct.
So, all right. So let's something else you should be doing. Adding to an HSA, if you have that through your worker. You love HSAs, don't you?
They are my favorite account. I mean,
Really?
I will preach all day about the HSA. I mean, it's the only account that is tripled tax advantaged.
Yeah.
So an HSA is a health savings account, and it needs to be coupled with a high deductible health plan, HDHP. But the cool thing about this account is that your money going into it that you contribute, you get a tax deduction for. So it takes away from your taxable income on your tax return. And then once it's in the account, don't use it for your healthcare expenses. And that's like the biggest trap. Everybody's like, well, I get the credit card. I'm going to use it for my copays and my prescriptions. And okay, that's tempting. But if you have the discipline and you have the cash flow to not use it for your, everyday health expenses throughout the year, this is not an FSA account, a flexible spending account, which is the use it or lose it account that a lot of people are used to. This is totally different. The HSA account, you can roll over, and that's what we want to do, because the HSA dollars grow tax-free every year. So you're not paying any income tax on those dollars as they grow. And so then in retirement, you can use these dollars for any medical expenses, long-term care, whatever treatments you might need. And when you take them out, guess what? They're tax-free.
Right.
So, I mean, it's like better than a Roth IRA account. So there's no other account like it.
And when you get to retirement, you're going to have premiums. There's no one that doesn't have premiums for
Exactly.
their Medigap or Advantage plans, right?
You're going to have healthcare costs up the wazoo in retirement.
So we found this thing online. It's avoid making these 11 money mistakes in retirement. I love Google, by the way. We hit most of these, but they reiterate again, you got to have a plan, right? I mean, we even have an hourly planning service. You don't have to be $10 million or $5 million to be to get our expertise. You can come in, pay by the hour, which we convert into a flat fee. So for a flat fee, we can do a complete plan for a DIY investor. It's really, really straightforward. More people in our industry should do it. They're just scared to work hard. Not maintaining enough liquidity. That's something that, your income goes up, probably your expenses have gone up, and now do you have enough in reserve? Well, you had enough reserve maybe in your 20s and 30s, but that $10,000 in that savings account is not going to cut it anymore, right?
Exactly.
Probably building something closer to 50 to 100 in reserve, more than likely. That's something that you should be focusing on. We mentioned this already, getting complacent about carrying consumer debt. It's really easy to say, yeah, I'll buy it. I can afford the payment. That's not how wealth builders think. They don't think, can I afford the payment, right?
Yeah, even getting saddled with all these zero interest loans makes me nervous sometimes. Yeah. Clients will come in and they'll say, oh, well, it's zero interest for 5 years. But then they've got this list of 6 different, monthly payments for all these zero interest loans.
Right.
But what if you lost your job? What if? And that just makes me nervous sometimes. So remember that when you're taking on all these monthly payments at zero interest.
Those zero interest cards, what literally happens if you haven't made all those payments by the time the promotional period ends, they back charge all the accrued interest that had been waived and then charge you with that.
Oh yeah,
well.
On the day after the
Right.
promo period ends.
Right.
You're right, Brad.
So to your point, if you lose your job or if you have another emergency that demands your dollars and you can't finish those payments on time, you will be hit with all that interest that was accruing in arrears. Yeah.
You know, something that I've tried to commit to myself is no more car payments for the rest of my life.
Yeah.
And it's you know, I do like nice cars. I have a hard time buying a standard car. So I won't do that either, probably. But, you know, we need a truck in our family right now because my daughter's habits of buying horses. And it's, you know, I'm looking at these ridiculous prices. People are putting used trucks up on Facebook with 40-something thousand miles, and they're still asking $80-something thousand
Yeah.
for the truck. You know, and you start doing the math of this higher interest rate environment. Like, I feel like me in my 20s have been like, oh, yeah, we need a truck. Let's go buy a truck. I'm like, you know what? I'm going to just keep putting money aside.
Mm-hmm.
And then we're going to, we have a vehicle that can pull it just fine. Not as cool as the other people. And
Right.
sometimes you get, the Suburban just gets so dusty and nasty when at these horse shows. But, you know, I look at it as I'm trying to build wealth. And I feel like the only person I'm making wealthy is the bank.
Absolutely.
Because I think at the credit union right now, I think it was 4+% on car loans, I believe. Maybe in the high threes, which means that no one's probably getting the high threes. They're probably getting something just above that. And it's a higher interest rate environment. We're getting money in our savings now. But, you know, I just, you know, it's hard. You sit through carpool line at the kids' school and you see new Yukon XL after new Yukon XL and the Navigator and the high end, you know, and I'm thinking, you know what? Let them waste their money. It's
right.
time to do you, not
And-
focus on anybody else, right?
So you just have to do that once, you know, save up to pay cash for that car.
Right.
And then have the discipline of putting what would have been the monthly payment
Back into your savings.
a savings every month.
Yeah.
And then you're set. And then you're always paying cash for that vehicle.
Yeah.
And you're paying yourself interest.
There are still some 0% offers out there. But I don't know that they're really 0%. I haven't looked that much into it. I noticed that GMC was offering 0%, but it's only 3 years.
Okay.
So you do $100,000 vehicle over 3 years, 0%. That's pretty hefty.
Almost $3,000 a month.
That's a pretty. I think it after everything ends up being like $3,500 a month. So that's a pretty hefty payment on something like that. But I don't know. I mean, I know that not everyone can do that, but I think that that's just, it's a depreciable asset, right? Try something that gets the job done and put that money to work somewhere else.
My thought was, well, you know, when the kids are that age, that I was in my 40s, they're going to wreck it anyway.
Yeah.
My son used to put his baseball cleats up on the dashboard.
Yes.
To tie them up before we get to the park. I mean,
Yes.
I just, okay, whatever. I had an old car and it worked just fine.
Right.
You know?
I'm sensing that now. I get very irritated when I
Yeah.
see actions such as that.
They
I'm like,
they
it's the
just
only car we got. You got to take care of it.
Or you say, this could be yours one day.
That's it.
That
yeah.
changes their behavior
That's
quite
true.
quickly.
This could be your car one day. You're gonna put your cleats up on my dash. Okay, so a couple of things. Remodeling homes, assuming that remodeling your home is going to add value. I don't think that your primary home is actually an investment. I think some people get lucky, but it's a big investment. But it's not like, you don't look at it as your future. Does that make sense?
Oh, I agree. And, you know, some people love to make the argument, but I'm going to stay in here forever. And so I agree with that to some point, but I think you need to draw the line. Like, you can't have a $2 million house in a $1 million neighborhood because you're never, ever going to get $2 million for it.
Right.
So, yeah, you can customize it and make it your forever home as long as you're fine with knowing you're never going to get that
Get money
out of
back out
it.
of it.
I mean,
You know,
your kids are never going to get it.
HGTV actually has a list of 15 home improvements that actually pay off.
Oh.
I'm surprised the top 5.
Are you looking at it?
Yeah, I don't want to go through I don't want to go through the 15, but
What are the good ones?
all right. So the number 1 is a minor bathroom remodel or kitchen remodel. Minor. So you're not ripping it. Maybe you're just putting new countertops in and you're doing some painting or something.
Okay.
Right. I mean, that sounds like a flip it thing, right?
In 30 minutes.
Yes.
More or less.
With I think about whatever. Chip and Joanna, like she's like her almost never there. I'm like, who does all the work? I don't understand.
Chip.
I guess so. Improving your outdoor landscaping. I'm surprised that's on there, but I guess it's like curb appeal, right?
Oh, yeah.
Curb appeal. Updating. Well, here's curb appeal again. Updating the front entry of your home and converting an attic space to a bedroom.
Oh.
Which I totally get that.
Adding a bedroom, yeah.
Because adding a bedroom, but an attic space, so you've got all the structure there. Probably just need to add like HVAC or something. But yeah, anything else is like I've had people come in and our clients over the years and say, "Well, my real estate agent said I have to redo my bathroom and it was like a $90,000 remodel." And I said, I doubt you had to have done that.
Yeah, that extreme.
That makes your house easier to sell.
For
right?
them.
For them. But yeah. I guess we can talk about retirement or college savings. You got to make sure that your retirement's on track first. There is no retirement loan. It's just working longer. So, 529 Coverdale's or a brokerage account, something, you need to be doing that. So ignoring that could cause some problems for you.
I think people get overwhelmed when it comes to college savings, don't you, Missy? I mean, the costs are so exuberant. So they say, yeah, what's $100 a month going to do? Well, I'll tell you what it's going to do. It's going to do $100 less in a loan that you're going to have to take out and pay for 30 years. So any amount that can be put aside for college and utilized, you put a fence around it and say, this is for college, that's $1 that you don't have to borrow later. But it can be overwhelming. You just can't let it overwhelm you when it comes time to starting to save some money for the kids.
Like you're literally going to be struggling the rest of your life if you rob your retirement at age 40 to pay for kids' college.
Yeah.
Because college is so expensive.
Oh.
I mean, in some sense, it'd be kind of like if you're flying an airplane and you took the oxygen mask down and you wore it just in case there was an emergency. You're going to run out of oxygen.
Yeah.
Waiting for the emergency. Then you have no oxygen.
Pilots should never talk about the things that can happen.
I know.
If it's okay for them to talk about it amongst themselves.
You would run out?
I'm just saying you would run out of money before you even got to retirement.
I was worried about the oxygen
Yeah,
on a plane.
As a passenger, we never want to think about that.
Airplanes are rated. They have enough oxygen generators, and the airplanes are rated on high they can go to a certain extent, to how fast they can get back down below a certain altitude, so you can breathe.
Oh, okay, I gotcha.
So basically, it's how fast. I think it's 12,500 feet, something like that. How fast can an airplane descend to hurry down to get you back?
Straight down.
Yeah. Okay, so the moral of the story
the moral of the story is that you don't want to rob your future reserves.
No, that's just crushing your retirement.
There's no way you can overcome that
recover
other than through inheritance or lottery winning.
Yes. And death is not a solution to retirement.
Yeah. Yes, that's right.
I've told clients that before.
Right. That's true.
It may be over for you, but the rest of us,
Right. Not diversifying your investments. We kind of covered this in our 30s, actually, is it's time to have a grown-up portfolio. So, if you're picking individual stocks and crypto and it's, 80% of your portfolio, those individual securities, it's time to grow up.
Well, to Missy's point earlier in the conversation is that we often see people who have accumulated multiple accounts here and there, and they were all set up with well-intentions.
Yeah.
But the follow-through just didn't work.
We had one
combining them and creating it with a purpose and with follow-through as well. So
says the investment guy.
Says the investment guy. Yeah. We had one that broke a record this last week. I've never seen so many accounts. It was crazy.
Like 24 accounts. Yeah. Well,
for one person.
On the flip side, we're talking about, individual stocks. It's not the time. A lot of times you find people in their 40s that start to get scared and their portfolio might be too conservative and they might not have enough risk in their portfolio to get them to retirement and into their 90s, which is another red flag. So we need to make sure that people in their 40s don't draw back on the risk scale and not have enough growth opportunity in their portfolio.
Right.
With people who are earning
but it's okay
big
to
salaries, I mean, they're putting away money in the 401k, and it's just natural to set up your investment, portfolio through that. But with that next dollar, they become a little hesitant and a little concerned about what do I do with it?
Want to make sure I keep it.
Right.
Mm-hmm. Yeah. It's okay to think more conservative, though. I mean, you shouldn't be in your 40s, but it's okay to start thinking more conservative. But translate that into planning, not buying CDs and bonds with your money at this point in your 40s.
No, that's only halfway through your life expectancy. What we're talking about today in your 40s. Well, in terms you're planning life expectancy.
I don't know. You're planning life expectancy. We're taking them out to 95. So.
Yeah. Not even halfway then.
Yeah, it's not even halfway. But in a traditional planning, yes, you are correct. Most firms plan to like 82, 85, somewhere in there. All right. So I think we covered that pretty well. Good job, guys. I don't I don't think that there's not any one particular thing that you have to do in your 40s, other than just you need to be, every year you should be evaluating where you are and where you're headed and what your goals are. I think it just goes back to, I just don't know how anyone lives their life day to day to day and they don't have goals that you set for themselves. Now, maybe a lot of people don't. I mean, that's not how I operate. But I'm an entrepreneur. I'm a business owner. So I'll say to the business owners out there in your 40s, you may not have a whole lot of saved for retirement. So now it's time to really do a gut check and look at your business and go, is this a business that I can continue to invest in? And new dollars that are going in, or are those going to translate into a business sale in the future? And if it is, and if that's a clear path, then you keep doing that. You may not need stocks and bonds initially until much later. But you got to make sure that you're actually doing it right. And we have some great business books. We always recommend E-Myth by Michael Gerber. If you need to really turn your website around and get your sales going again, look at Donald Miller and Building a Story Brand and Marketing Made Simple. If you're in the service industry and you stink at it, look at Danny Meyer's his book on Setting the Table. First 3 chapters, I think he talks a lot about himself, and you're gonna wonder why I recommended that book. But stay tuned to that book. That book can change your service mindset. So there's a lot of books out there that can help you as business owners really focus on what the end goal is. And also there's Business Made Simple University. I think it's like $250 a year. It's done by Donald Miller and his team, and they have some great tools, well worth the $250 for business owners to kind of navigate through. All right, guys, great conversation. We'll see you next time.
Sounds great.
Thanks for listening to a Wiser Retirement podcast. We hope you enjoyed today's episode. Make sure to subscribe wherever you're listening, that way you don't miss any new episodes. We would also appreciate if you could leave a rating and review. If you have any questions about anything that was discussed today, head to wiserinvestor.com and reach out. We would love to hear from you. This episode was produced and edited by Lilton Moore. This podcast is strictly for informational purposes only and is not to be considered as investment advice or a solicitation to buy or sell any financial products, securities, digital assets, or any other investment vehicles, or a basis to make any financial decisions. Wiser Wealth Management Incorporated is a registered investment advisor with the SEC. The host and or guest may personally own securities, digital assets, or other investment vehicles mentioned on this podcast. Neither the host nor guest of the show are compensated for their participation, and no referral fees are paid to or received by any host or guest for clients, listeners, or similar interests. Investments involve risk, and unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor, tax professional, insurance professional and/or legal professional before implementing any strategy discussed herein. Past performance is not indicative of future performance.